Welcome to the 15-Minute Financial Feast podcast, bringing you 15-minute segments to help you retire with purpose on time. We're serving up food for thought and bread for the head. Are you hungry to learn? Here are your hosts, Mark Triplett and Troy Westendorf.
During this episode of the 15-Minute Financial Feast podcast, we're listening in on Troy Westendorf and Mark Triplett's Lunch and Learn series, where they covered a wide variety of retirement and tax planning strategies to help you retire with purpose on time.
Hey everyone, welcome to our 15-Minute Financial Feast. My name is Mark Triplett.
Troy Westendorf.
This particular session, we're going to be talking about 3 common misconceptions around Social Security. And so this particular 15-minute segment, we're going to first start with stopping by each one of those misconceptions. Then we'll talk about how those misconceptions often lead to suboptimal and irrevocable claiming decisions. Those are bad news. And then last, we're going to round out 5 good reasons to consider actually taking a delayed strategy when claiming Social Security.
I like it. So everyone has an opinion.
Oh, yeah.
Right? Regardless of it's Social Security or what it is. But we'll stick to Social Security today. But everybody has an opinion. So, Mark, why don't you go through some of these on what some of these opinions have to do and why it can be damaging when it comes to Social Security?
Sure. Well, I mean, first of all, when we mean everybody, we mean everybody. I mean, you're certified public accountant. Maybe if you have a financial advisor, they have an opinion. And maybe they have some credibility because maybe they actually understand the program. But then you have news media outlets talking about Social Security, and they get things wrong. And then politicians using it as a political football to kick around. And then, last but not least, your coworkers, family, friends.
Uncle Bob,
Yeah. And oftentimes those who have the least understanding of the program, they're often, and the most uninformed folks, they're often the ones that espouse to tell you that their thoughts as if they're real, and yet they're often overly confident in their opinions, and they'll tell you just what you should do. And those are the most dangerous opinions, in my opinion, because they think they know, but they don't know. They don't know what they don't know. And we've, my fear as a financial professional is that our clients would act on some of those without discussing it with us. And because we do get questions, even though we work with folks to set a course for claiming strategies, it almost never fails that we end up with folks coming back to us later on and saying, well, I'm thinking about doing this instead. And we have to kind of go back over the strategies. But it's always as a result of talking to somebody else who is not a Social Security expert. Anyway, so that's the kind of challenge. I would say the biggest challenge that we face on an ongoing basis is just overcoming those myths and trying to keep the record straight for our clients, because it's a very confusing program in itself. Understanding all the nuances of how and when to claim your Social Security benefits or your spousal benefits, if you're eligible for spousal benefits, or how does it impact the survivor benefit. And we're going to talk about a lot of that, but just understanding that entire program in itself, and getting the emotion out of it, because I think a lot of the decisions and a lot of the opinions that are opined by folks who really don't understand are more emotionally based than they are in understanding how it works and the facts.
So, yeah, absolutely. So, and you talked a little bit about misconceptions. One of them is, I want to get it before it's gone. So it's going broke. Right?
Social Security is going broke, Troy. I'm going to get the getting while it's good.
It's going broke, which is why we see that about a third of the people are claiming at age 62.
Most popular age to claim.
The most popular age to claim. And then we know that beyond that, we have 2/3 that are claiming the benefit before their full retirement age.
It's true, and if you claim as early as you possibly can, you're going to forego at least 25% of your full retirement age entitlement benefit. And I say at least because for some folks it's even more. But I mean, you're talking about if you have a $2,000 benefit that the Social Security Administration says you're eligible for if you wait till your full retirement age, which is based off of your date of birth.
Right.
$2,000 a month becomes $1,500. So what happens to the other $500? Well, it's gone. You forfeited it. How long? Forever. It's permanent. You've permanently forfeited a quarter of your benefit. And not only that, you permanently forfeited the cost of living adjustment that you would have received on that $500 in that case. So it's an emotional decision because people want to get the get while it's good. They paid in the system. They want to get their money now. It's my money. I want it now. Right.
I'm not going to live forever.
Right. Yeah. That's another one. And so they make these emotional decisions that are permanent, irrevocable, and they can have lasting impacts not only on them, but if they're married, the surviving spouse.
Yeah, which is a huge impact. Yeah. So maybe at a single, it's not quite as many parts playing into this. As a married couple, it's huge.
It is.
We've noticed that in the plans that we put together, it has a major impact.
But even as an individual, on an individual basis, I mean, the waiting just for retirement age can add tens of thousands of dollars in lifetime benefits just for yourself, just by waiting. I mean, the math works out that way.
Absolutely.
Unless your life expectancy is presumably going to be cut short
health
for one
issues,
reason.
Absolutely.
Misconception number 2, Troy, is checks will stop when the trust fund is exhausted. So when this trust fund has no more money in it, there are no more checks to send out. So I want to get that. I want to get my benefits now before it runs out, because once it runs out, and there's no more money, no more checks. Right. And what is the reality of that, Mark? What is it going to be reduced if that trust fund does get exhausted? So it's one of the questions we actually ask in our live classes. If you're receiving Social Security checks and all of a sudden the trust fund runs dry, are your checks going to stop? And the Social Security Administration, their trustee report each year that comes out, the Social Security Administration trustees estimate how long the trust fund will last under current circumstances. And it's somewhere between, they expect the trust fund to be exhausted somewhere between 2033 and 2034. And that does fluctuate from year to year as revenue comes into the Social Security system and as more folks go on claim and benefits are coming out. So it does change, and the trustee report comes out. I think it's October of every year or something like that. Anyway, don't quote me on that. I know they make adjustments to Social Security in October that take effect in January as far as cost of living adjustments. But every year the trust fund or the trustees put out a report and they say, here's what the health of the program is. But by 2033, 2034, they're estimating that the trust fund will no longer have any surplus in it. Okay, trust fund is empty. Will checks actually stop at that point? And the answer is no. The checks won't stop because the government has ways of raising revenue that you and I don't.
Right.
Okay? They're going to continue to tax people that are working. They're going to continue to tax employers and employees. So when you look at your pay stub and you see taxes for FICA, you'll see FICA. Well, that's your Medicare tax and your Social Security tax. And so they're taking 6.2% of your income, your employment income, and they're taking 6.2% from your employer, so a total of 12.4%. And that's going to fund Social Security. So even if the trust fund is empty, there'll still be taxes coming in to then go pay out as benefits. Now, it could be a reduced amount. And the estimate now is that if no action is taken by Congress to make any changes to the Social Security system, by 2033, 2034, when the trust fund is projected to be empty, you might have reduced benefits. How reduced? About 75% or 75 cents on a dollar of your full retirement age benefit. Well, I'm already going to get a reduction. Why don't I claim early? Well, because if you claim early and you take the permanent reduction because you claimed early, 25% reduction at age 62, and then we get to 2033 and there's a reduction in benefits because they haven't made any adjustments to the trust fund. Well, you're going to get a reduction on your already reduced benefit. So it's going to affect everybody, regardless of whether you claimed early or whether you waited to full retirement age. So the checks won't stop. They could be reduced. But there are a lot of different things that could happen between now and 2033 that would make the program solvent. They could increase the Social Security tax. They could increase the amount of income somebody makes in a year that is subject to tax. Right now, there's a cap on it. So about $142,000. If you make more than that, you're not going to get taxed on it. And that indexes each year and increases each year. But for 2021, it's right around $142,000. So yeah, the reality is they could increase that earnings cap, the wage cap, And that would make the system flush with cash if they just eliminated it altogether. Or they could increase the payroll tax from 6.2 and maybe increase that by a couple percentage points, some from the employer and some from the employee, and increase that by a net of 3% or so. And that would make the system flush with cash. So there are different ways that they can make adjustments. And I fully expect some sort of legislation to be passed sometime in the next decade that will address these issues. But even if there were none taken, checks won't stop.
Right.
Okay.
Yeah, and then we'll talk. And you mentioned a little bit about the misconception 3 is I'll receive more money over time if I claim early. And so when someone logically looks at this, they're thinking, well, if I'm going to claim additional checks from 62 to 65, so I'm going to have X amount of checks more coming in. How am I not going to be better off by claiming early?
Right. I claim at 62, and let's say my full retirement age is 66. Okay.
Right.
So there's 4 years of claiming benefit checks that if I wait till full retirement age at 66, for example, I don't get those. But it's a reduced amount. So I'm getting more checks, but they're smaller checks. If I just wait to full retirement age, I get 100% of my benefit. And if I wait beyond that, then there's even a delayed credit added in addition to that. Once you get to age 70, you shouldn't delay any further than that. There's no delayed credit beyond age 70. Everybody should be claiming Social Security benefits by age 70. There's no reason to delay beyond that. But just if you look at claiming early at 62 versus taking delayed strategy, if you claim early at 62, remember we were using that example of $2,000 a month benefit. Oh. If I claim early at 62, that $2,000 a month benefit becomes $1,500. Yeah. Now I get a cost of living adjustment. Let's say we say the cost of living adjustment is 2%, and I live to age 90. Okay, so I collect checks over 28 years. In that case, I'm gonna actually claim about $666,000 worth of Social Security benefits over that period of time, which is a pretty significant amount of retirement resources if you compare it to 401ks and IRAs and other IOUs, the IRS, that you'd have to make up somewhere else. So Social Security is often one of the largest assets, retirement assets that folks have, and often the most mismanaged. Now, if I just wait to full retirement age at 66 in this example, I get my entire $2,000 per month check, no reduction. I still get the 2% cost of living adjustment, not on $1,500, but on $2,000, adjusted for inflation going forward. If I assume living to age 90, just like in the first case, I'm only collecting checks for 24 years, right? Because I've waited.
Right.
So I get 4 years fewer checks, but they're bigger. And the cost of living adjustment is larger because it's on a larger amount. Right. I'll actually end up with a significantly more money, about $63,000 more in lifetime benefits over that same period of time. So we're talking tens of thousands of dollars in benefits that I would have foregone had I claimed at 62. And that's not even coordinating between spouses. That's just looking at your own benefits. Yeah. So claiming, this misconception that if I claim early, I'm going to get more money in forms of benefits is not accurate. In fact, the Social Security Administration has a disclosure on their website that says that claiming early is likely to result in significantly fewer benefits. So anyway, so that's misconception number 3. So let's talk about some of the reasons why you might want to delay.
Well, and you mentioned one of them. There's no forfeiture of the cost of living adjustment, which is a big impact, which you were talking about. If we claim early and don't have the cost of living adjustment, it has a big impact. And you said earlier it could be 63,000 is kind of the number you threw out there. If we don't have that extra $63,000, then we have to go get it from somewhere else.
Yeah, and that $2,000 a month benefit example with a full retirement age of 66, we're talking about having $63,000 worth of additional lifetime benefits in that particular hypothetical example. That's tens of thousands of dollars of government-backed, inflation-adjusted, tax-advantaged income that if we forego that just by making a claiming error or purposely claiming early just because we want to get the gut, well, it's good, one of those misconceptions, we now have to make that up somewhere else from IOUs, the IRS, like IRAs and 401ks, or maybe work longer or have a part-time job or something. That has to come from somewhere. And so foregoing those dollars is going to cost you in the long run. The other another good reason is if you're still working and you're younger than full retirement age, there are limits to how much money you can earn and still collect benefits from Social Security.
Yep.
So in that particular situation, if you're making more than about $18,000 a year from your employment, and you're younger than your full retirement age, and you claim Social Security, you're going to get back $1 for every $2 you make over the earnings limit, and it's indexed every year. So I threw out the number 18,000, but it's a little bit more than that this year, and that increases over time. But the reality is, this earnings limit limits folks who are full retirement age. So they're younger than full retirement age. It prevents folks from earning a lot of income and actually collecting benefits. So it may not make sense to claim if you have really good income and you don't plan on separating from your employment service for a number of years.
Right.
So that has to be decided. So just avoiding the earnings limit is a good reason or a good excuse. And Troy, talk to me about supersizing the spousal benefit.
Yeah, so we do that quite often here. Normally, it's the male that is the higher age earner, but whoever the higher age wage earner would be, we usually delay it to get that income benefit as high as we possibly can, knowing a few things. If that spouse should pass, let's just say it's the male in this case, the surviving spouse would claim the higher of the two benefits. So we're always trying to get that benefit as high as we can possibly get it, knowing that there's a really good chance, because the odds of the male passing before is really high.
Well, so, we're just talking about, in this case, we're talking about just the reality in our society that oftentimes a married couple, when it's a man and a woman, and it doesn't have to be a man and woman, there same-sex marriages, and those are recognized as well. But I'm talking about, in this case, I'm talking about a man and a woman.
Right.
Oftentimes the husband is older, not always the case, but oftentimes that is the case. Oftentimes the husband did not stay home with the children if they have children in the house, and the younger female spouse did. So that can end up making that female spouse, that younger female spouse, a lower wage earner. So that benefit from Social Security is often going to be lower. The male's older, not likely to live as long,
right,
has a desire to claim early, but it can be a very selfish decision to do so, when in reality, they want to expand that survivor benefit to the maximum we possibly can. So oftentimes the selfless decision in that situation is for the older male spouse, who is a higher wage earner, to delay, to maximize that benefit on his record, because the younger female spouse is likely to inherit that and live quite a while collecting that benefit. And claiming early in that situation would permanently reduce that survivor benefit that spouse is going to receive in the future. Again, it's not always the case where it's a male who's the higher wage earner. Right. It's not always the case where the male is the older individual. But men live shorter lives statistically than women. Women tend to live longer. If there's a younger female spouse who stayed home with the kids and has a lower Social Security benefit, and the male and the husband in this situation has a higher benefit, it oftentimes makes sense for the lower wage earner to trigger Social Security earlier, getting cash flow into the household, but allowing that higher wage earner's benefit to expand. Even if the life expectancy of that person's shorter, we're doing it as a household to optimize the survivor benefit for the younger spouse, who's likely to outlive that other individual for a very long time. So it's definitely a decision that can't be made in a vacuum. It has to be coordinated with both spouses and all of your other retirement resources. This is not something you want to take lightly.
Right. And you kind of hit on, we're living longer. A married couple age 65 now has a 90% chance of 50% chance, of making it to age 90.
Absolutely.
So if we don't when we put a plan together and we don't plan on age 90 or in your 90s, we now have a 50% chance of a failure rate with our plan.
That's correct. Yeah. So we've got to account for the fact that we're all living longer. And unless you have some sort of medical condition personally, or something hereditary that runs in your family that might shorten your life expectancy, if you have longevity in your family, you really have to take a hard look at how to optimize Social Security, because it's the only government-backed, inflation-adjusted, and tax-advantaged income source you're ever going to have access to in retirement. So don't let that go to waste. It's tax advantage. I just mentioned that at least 15% of your Social Security benefit is going to be free from federal income tax, maybe more, right? But for folks today, at least 15% is going to be income tax free at the federal level, and could be substantially more than that if you do proper planning. From a state level, some states tax Social Security, some don't. In Iowa, Social Security income is not taxed. IRAs, 401ks, and other distributions from IOUs, the IRS, are taxed at the federal level and the state level. So if you can optimize Social Security, which is tax advantaged, particularly in Iowa and other states that don't tax Social Security benefits, it can have a huge impact in how your retirement resources last. Maybe it makes sense to spend some of your pre-tax money, your IRAs and 401ks and other IOUs, the IRS, while you're delaying Social Security, so that when you trigger that later on, fewer of your Social Security dollars are subject to tax, and therefore more of your income you get to keep and use to live your lifestyle. So having the tax advantages of Social Security benefits is a tremendous reason to consider taking a delayed strategy, growing that benefit, and having that a larger benefit available later in retirement.
Absolutely.
So that really covers it for this session. We went a little bit longer than our 15 minutes, but I really want to impress upon folks that do not take this decision lightly. This is not something to do on a napkin. We have sophisticated programs that we use to help evaluate these decisions for folks. I'm sure your financial advisor, if you have one, has the capability to do this. Just press them on it. Don't take a simple answer from that individual. Make sure that you press your experts who are helping you put your planning together to evaluate all of your planning options and help guide you to make a decision where you're coordinating spousal benefits, survivor benefits, as well as your own worker benefit from Social Security, the three components of it, with your other retirement resources, pension if you're fortunate enough to have one, your assets like IRAs, 401ks, your after-tax brokerage accounts, and really coordinate all of these together before you make an irrevocable claiming decision and optimize this for you. Because we really, at our firm, we want everybody to retire with purpose on time. And every dollar has a purpose. Every dollar has a timeline. Social Security is no different. It has a purpose. It has a timeline. It has a role to play. And to get the best optimal strategy, you have to know how to coordinate all three components: your worker benefit, survivor benefit, and the spousal benefit.
Absolutely.
So thanks for joining us for this episode. By the way, if you have questions about the topic that was covered today, you can visit mypt5.com. That's www.mypt5.com. And there's a place to enter questions there. It'll come right to us, and we'll try to address them for you. Until next time, retire with purpose.
And on time. Take care, guys.
You've been listening to the 15-Minute Financial Feast podcast. Remember, every dollar has a purpose and every dollar has a timeline. If you have questions about today's topic, schedule a call with a team member. Visit www.mypt5.com. Until next time, be sure you're taking steps to retire with purpose on time. Mark Triplett is an investment advisor representative of and advisory services offered through Royal Fund Management, LLC, an SEC-registered investment advisor. Nothing contained in this program should be considered an offer to buy or sell securities. Different investments have different risks associated with them, and not all investments are appropriate for all investors.